Good day, everyone, and welcome to yet another edition of the BCAS Tax Gurukul. I'm Ameet Patel, member of the Taxation Committee of the BCAS, bringing to you this edition of the Gurukul. And the topic that we have today is reporting of foreign assets and foreign income to the Indian tax authorities. First, why a video on this particular topic? The reason is that because the income tax department has stepped up an aggressive, and I would say very aggressive drive under which summons are being issued to a large number of taxpayers asking various details about foreign assets and foreign income. So if you have any foreign assets or income and have not shown the same in your IT return in India, be ready for a notice or a summons if you have not already received it. The Indian government, as most of you would be aware, is continuing to get a lot of information under the Automatic Exchange of Information Agreement with governments of various other countries. And this information is about assets held by Indians in other countries. The department has a separate wing called the Investigation Wing, which has got this information. And this wing matches that information with the data that each taxpayer files in his or her ITR. And wherever there is a mismatch, notices or summons are being issued. And there is a penalty of 10,000 rupees for every failure to respond to a summons or to give evidence or to produce books of account. So if you fail to respond to such a notice or a summons, then every failure would invite a possible penalty of 10,000 rupees. Now, who has to declare the foreign assets in the Indian ITR? Any individual, including a beneficial owner or a beneficiary, who is a resident and ordinarily resident in India for tax purposes, such a person needs to declare foreign assets in the ITR. And this schedule need not be filled up by a person who is not ordinarily resident or a person who is a non-resident. Resident HUFs, partnership firms, trusts, companies, LLPs, AOPs, all these are required to declare the foreign assets in the ITR. In case of trusts, the settlor, trustee, or beneficiary also required to declare the foreign assets in the ITR, and similarly a representative assessee. And what is it that has to be declared? Any asset located outside India, held at any time during the previous year, and any income derived from a foreign source, as also any foreign liabilities pertaining to the foreign assets which one is declaring. Bank accounts, accounts in which you have a signing authority, mutual fund investments, retirement accounts, social security account, insurance contracts, joint accounts, all these are required to be declared in the ITR form. At the same time, if one has foreign currency on hand, that is presently not required to be disclosed in the ITR. Now, foreign asset reporting for a resident and not ordinary resident or a non-resident. So we saw up till now what a resident and ordinary resident taxpayer has to declare. But in case of RNOR and NR, shares in unlisted foreign company are to be declared. These are to be declared by even a resident and ordinary resident. Then individuals qualifying as non-resident or NOR are also required to disclose details of the directorships in a foreign company. And wherever applicable, foreign assets to be reported in Schedule AL also, apart from the other schedules where the foreign assets are to be reported. Schedule AL, you might be aware, is a schedule where in case of people who have income exceeding 50 lakh rupees, taxable income exceeding 50 lakh rupees, they have to specially and separately report certain assets and liabilities in respect of those assets in a schedule called Schedule AL. So a person who is who has a foreign assets and who is a resident and ordinary resident will need to disclose both in the Schedule AL as well as in the Schedule of Foreign Assets. This would also apply to NRs and NORs. To maintain proper documentation for the disclosure made in the ITR, is absolutely critical for anyone who is required to report such assets or income in the ITR. Schedule FA, that is Schedule of Foreign Assets. The general information required to be disclosed in the schedule are country name and code, name, address, zip code of the financial institution with which the account is maintained, the account number, the nature of the entity where the account is held, the status of the account, that is whether there is a direct ownership or a beneficial ownership or whether you are a beneficiary, then the account opening date, the peak balance during the period, closing balance as at 31st December 2021. Now, this is with reference to the return of income for assessment year 2022-2023. For the returns for this year, the closing balance as at 31st December 2021 is also to be reported. Then gross interest paid or credited during the year, the initial value and the peak value of the concerned investment, the gross proceeds from sale or redemption of investments during the period covered by the return, surrender value and insurance premium paid as regards the insurance held outside India, and schedule where the income from that particular asset is offered for tax or is disclosed in the ITR. That has also got to be mentioned in the schedule FA. As I said earlier, for AY 2022-23, the reporting of foreign assets or accounts, etc., has to be made for the foreign assets or account held at any time during the calendar year ended 31st December 2021, irrespective of the year or the financial year or the fiscal year of that other country. This is a big departure from the past, because in the past we were required to give information pertaining to our financial year, that is April to March, but with effect from AY 22-23, it has changed to calendar year. The rate of exchange for conversion of the foreign asset or foreign sourced income in Indian currency has to be the TT buying rate, and TT buying rate is the rate of exchange adopted by State Bank of India for buying the concerned currency. The date of the conversion of the foreign currency would depend on various factors. For peak balance, it would be as on the date of the peak balance. For the value of investment, as on the date of investment. Amount of foreign source income has to be converted into INR at the closing at the rate prevailing on the closing date of the accounting period. And for closing balance in the foreign asset, the value in INR is to be computed by applying the closing the rate as on the closing date of the accounting period. There are certain burning issues which a lot of taxpayers are facing, particularly those based in United States of America, where there are social security accounts or foreign retirement accounts. So the accumulated fund in such accounts qualifies to be a foreign asset for the purpose of the disclosures in the Indian ITR. One must also bear in mind its taxations, since it may not enjoy the tax exemption benefit in India like it does in the Indian retirement fund. So in India, if the amounts in the PF or similar other retirement benefit funds enjoy certain tax exemptions or tax benefits, whereas the balances in the foreign retirement fund would not enjoy similar benefits. Then there is a recently introduced section 89A, which would be read with Rule 21 AAA, which provides relief relating to the point of taxation of income from such retirement fund. And this may be kept in mind while computing the income for AY 22-23 and subsequent years. So some do's and don'ts while disclosing or not disclosing the foreign assets and foreign income in India. First of all, one must be very careful about the documentation of the working, how you have worked out the figures that you are disclosing. One must keep complete details of that working with proof of the documents, with proof of the screenshots of the exchange rates that have been adopted, copies of passport. This has become extremely important because wherever the summons have been issued by the department, they are asking for copies of all the pages of the passport, and they are matching each and every date of arrival into India and departure from India with the data given by the concerned taxpayer. So it would therefore be very, very critical to keep the copies of the passport, and also a diary or a chart containing the number of days of stay in India and outside India. Some don't skip the reporting the ESOPs that you may have in respect of any company outside India. And do not assume that if tax is paid in a foreign jurisdiction, then reporting is not required here. This is one of the most commonly seen misconception or misinformation that many people have about the foreign income, that if I have paid tax outside India, I don't need to report the income in India and I don't need to pay tax on that income in India. So these were a few important do's and don'ts. What happens if there is non-disclosure? So one has to be very careful in reporting foreign assets and income in the ITR, because if you flout these requirements, then action can be undertaken under you, under the Income Tax Act, under the Black Money Act, under FEMA, and under the Prevention of Money Laundering Act. Under the Income Tax Act, penalty could be levied for underreporting income at 50% of the tax payable on the underreported income, or for misreporting at 200% of the tax payable. The tax officer has the power to open assessment or reassessment up to 10 years from the relevant from the end of the relevant assessment year. And when the assessment is reopened, the AO has the power to delve into other matters apart from the foreign assets or foreign income. Under the Black Money Act, bona fide belief, inadvertent mistake, mens rea, mala fide intention, all these are very, very relevant. And one needs to be very careful about how you defend yourself if at all you are caught on the wrong foot. And the point of time for taxation, when an undisclosed foreign asset comes to the notice of the government, is that point when the government comes to know about the foreign asset. So it does not go back to the year in which you acquired that asset, or you are found to be to have become the owner of that asset. The point of taxation would be the point when the information comes into the possession of the government. Undisclosed foreign income and asset will be taxed at a flat rate of 30%. Exemptions or deductions which are otherwise available will not be allowed in such cases, and failure to furnish the return of income or furnishing inaccurate information where disclosure of foreign assets is required may result in a penalty of up to 10 lakh rupees under the Black Money Act. Additionally, a penalty of 3 times the tax may also be levied. And to protect persons holding foreign accounts with minor balances, which may not have been reported out of oversight or ignorance, it has been provided that failure to report bank accounts with a maximum balance of up to 5 lakhs at any time during the year will not invite any penalty or prosecution. So the moral of the story, ladies and gentlemen, is that please disclose your global assets and global income, whether or not the income is received in India, in your Indian income tax return, if you are a resident and ordinarily resident in India. If you are a non-resident or not ordinarily resident, then you don't need to worry as far as the foreign assets and foreign income are concerned. However, one needs to be very, very sure about the residential status of yourself or of your friend or family member, because merely on the basis of what you write in the ITR form, the ITO is not necessarily duty bound to accept that. He or she has every right to question the residential status and to verify the residential status. And therefore, please be very careful, because this is becoming a very, very serious matter. Thank you so much for viewing in the BCAS Tax Gurukul. Have a good day.